I think there is a class of businesses where the eventual cash back part of the equation tends to be an illusion. I think there are businesses where you just keep pouring it in and pouring it in, and then all of a sudden it doesn't work and no cash comes back. And what makes our life interesting is trying to avoid those and get on the alternative kind that drowns you in cash.
The one figure we regard as utter nonsense is the so-called EBITDA. I mean, the idea of looking at a figure before the cash requirements of merely staying in the same place, and there usually are. Any business with significant fixed assets almost always has with it a concomitant requirement that major cash be reinvested in order simply to stay in the same place competitively and in terms of unit sales. To look at some figure that is before that is stated before those cash requirements is absolute folly, and it's been misused by lots of people to sell lots of merchandise in recent years.
It's not to the credit of the investment banking fraternity that it has learned to speak in terms of EBITDA. I mean, the idea of using a measure you know is nonsense and then piling additional reasoning on that false assumption, it's not creditable intellectual performance. And then once everybody is talking in terms of nonsense, why, it gets to be standard.
Criteria for selecting a stock is really the criteria for looking at a business. We are looking for a business we can understand. That means they sell a product that we think we understand, and we understand the nature of their competition, what could go wrong with it over time. And then when we find that business, we try to figure out whether the economics of it means the earning power over the next 5 or 10 or 15 years is likely to be good and getting better or poor and getting worse. But we try to evaluate that future stream, and then we try to decide whether we're getting in with some people that we feel comfortable being in with. And then we try to decide what's an appropriate price for what we've seen up to that point. And as I've said last year, what we do is simple but not necessarily easy. The checklist that is going through our mind is not very complicated. Knowing what you don't know is important, and sometimes that's not easy. And knowing the future is definitely it's impossible in many cases in our view, and it's difficult in others, and sometimes it's relatively easy, and we're looking for the ones that are relatively easy. And then when you get all through, you have to find it at a price that's interesting to you, and that's very difficult for us now, although there have been periods in the past where it's been a total cinch. And that's what goes through our mind. If you were thinking of buying a service station or a dry cleaning establishment or a convenience store in Omaha to invest your life savings in and run as a business, you think about the same sort of things. You think about the competitive position and what it would look like 5 or 10 years from now, and how you were going to run it, who was going to run it for you, and how much you had to pay. And that's exactly what we think of as when we look at a stock, because a stock is nothing other than a piece of a business. Charlie?
Yeah, if finance were, when finance is properly taught, it should be taught from cases where the investment decision is easy. And the one I always cite is the early history of National Cash Register Company, and that was created by a fanatic who bought all the patents and had the best sales force and the best production plants, and he was a horse in the best production plants, and he was a very intelligent, was a godsend to retailing when cash registers were invented. So that was the pharmaceuticals of a former age. If you read an early annual report prepared by Patterson, who was CEO of National Cash Register, an idiot could see that this was a talented fanatic, very favorably located, and that therefore the investment decision was easy. If I were teaching finance, I would collect 100 cases like that, and that's the way I would teach the students.
Mr. Buffett, What is your opinion of investing in foreign company stocks?
Well, we have a number, well, at least several major businesses, 3 or 4, at least 5, 6, as I count along, that derive very significant percentages of their earnings from the international operations. Coca-Cola earns 80% or more from international operations. Gillette would earn 2/3 or more from international operations. So if you look to where our look-through earnings are coming from, we get a lot from international companies. They don't have to be domiciled outside the United States. It's a slight advantage to us to have them domiciled in this country. For example, their dividends are treated better. We get better treatment on the dividends if they are domestically based rather than based someplace else, just because of the way the U.S. tax laws work. But if Coca-Cola were domiciled in Amsterdam or Gillette were domiciled in London, they had the same basic businesses, we would be attracted to them to virtually the same degree we are as having them domiciled in Atlanta and Boston. We look at businesses outside this country that are domiciled outside this country. Many don't meet our size requirements, but that's true here too. But we have to look at very big companies. But we have nothing against buying into companies that are domiciled, or even buying the entire business of a company that's domiciled outside the United States. We feel slightly less familiar with the tax laws and the corporate cultures, perhaps, but that would not be a huge factor in a great many countries. And we will keep looking. We need to look everywhere with the kind of money that we have available for investment. Charlie?
Again, we've had a wonderful way of playing the rapid development of economies outside the United States, and so far we haven't seen anything that attracted us as being better. And if you can sell Coca-Cola, do you really want to get into steel in Malaysia or something?
We sold a substantial number of Kirby units outside of the United States last year, and that business has grown very significantly in recent years, and I think it promises to grow more. We're always looking for opportunities. Some things travel very well, and some things don't. I mean, Gillette travels, Disney travels, McDonald's travels, Coke travels. See's Candy doesn't travel as well. It might if you spent 50 years working on it, but it's not an easy thing to travel. Actually, candy bars themselves don't travel very well. If you look at the top-selling candy bars in France or in England, in Japan, you don't find the similarity that you find in terms of the best-selling soft drinks or movies or fast food hamburgers or razor blades. And
except Snickers, for some reason, Snickers.
Well,
travels very well. Don't ask me why.
Yeah. Well, Charlie's had a lot of experience as he goes around the world. You don't want to eat where we eat. You may want to invest where we invest, but